Hello and welcome back to the Microstructure Exchange. I see that we have almost 100 people here today, so it's going to be another well-attended seminar. Today we have Sunil Wahal, who's going to tell us about the anatomy of trading algos. So that's going to be very exciting. I will be the moderator today. I'm Björn Hagströmer from Stockholm University. And before I hand over the screen to Sunil, I'd like to make a couple of quick announcements. This initiative is taking off really well. We're excited to see today we reached 450 subscribers to our newsletter. So thanks everyone for tuning in here. And we think this creates a quite nice channel for the microstructure community in general. That makes it fit for making announcements that is relevant to this community. And we have a couple of announcements added now to our website. And one of them is a new data set that Sunil will talk briefly about. That is a daily data set for bid-ask spreads and price impacts that is calculated from TAC and made available very generously by Sunil on his web page. And the second one is a special issue of the Journal of Banking and Finance. Clara Vega will be one of the editors, and this special issue is focused on the microstructure during the time of the pandemic, basically. Various takes on how the financial markets have been affected. So if you go to our website and scroll all the way down, you will see these announcements. So the format of the seminar is the same as last week. For those of you who were here, we will have about 45 minutes presentation by Sunil with a couple of breaks for questions. And if you want to ask a question, you should use the Q&A function in Zoom and enter your questions there. And if you see that someone else posted a question that you would be interested in hearing the answer to, you can upvote the question, and you can also comment on each other's questions there. And during the question breaks, I will read these questions to Sunil. And then after this 45-minute session, then I will open up for the raise hand function. So then we'll open up the floor for any question that remain, and I'll give the word to those who raise hand, and you can ask your questions yourself. So without further ado, I'll hand over the screen to Sunil.
Good morning, everyone. Or I should say good morning, everyone, to those for whom it is morning, and good afternoon and good evening if you are elsewhere in the world. I'm assuming that you can see my screen. So let me take 30 seconds to talk you through where this database resides that Björn very graciously discussed. The link is on your screen. It's essentially a public access database of daily information, as he mentioned. It's going to include all common stocks and ETFs, and the beta version of the website is up already. I'll show it to you in a second. And it will be updated overnight with a one-day lag. So today should contain yesterday's information once we have everything complete. If you can see this now, then, and hopefully everything is smooth, you can see what the data sets look like, what the spread statistics look like on the web page. Let me show you a single page. So there's ability to obviously select here particular dates and download functions for the entire day. If you click on a particular day, This is what things look like. You can search here by symbol if you want. For people who want to look for specific stocks, you can also search here. And you can see specific things getting picked up here. So again, this is for public access. Hopefully everything will be up and running soon. So let me start talking about trading algorithms. First, let me mention that this is joint work with Tyler Beeson, a PhD student at ASU, and Tyler will be on the market next year, assuming everything is open for business, which we certainly hope so. I'm going to zip through some of this stuff fairly quickly because it's largely descriptive, and I'm going to spend very little time on motivation here simply because of time. But I don't think I need to tell this audience that the classical models that we have, price formation, are basically those that were constructed in the 80s and thereafter in a microstructure that is very difficult or very different today. On the last 10 years or so, there are a variety of new models in market microstructure that focus largely on high frequency trading, and they mostly ignore the buy side or large institutional investors and their contribution to price formation. That's natural because of the prevalence and the dramatic increase in high frequency trading. And so the trade-offs in many of these models has always been with respect to speed and prices and adverse selection and things of that nature. There's one exception I do want to note, and that's a relatively recent paper by Li Wang and Mao Ye that does discuss the buy side's role in this. And I think part of the reason why we don't have such a good foundation for the buy side is because of lack of data. It's sort of quite simple. Institutions themselves don't want to release the data. They think that releasing it reveals proprietary information. Brokerage firms just as well don't want to release it because that reveals the proprietary nature of some of their algorithms. You know, some folks or a variety of papers have used Incerno type data for different things. For the purpose at hand, that data are largely useless for our purpose, that is, and that's because those data are largely based on end-of-day trading tickets as opposed to precise details of execution. There are some single manager data sets out there that some folks have worked with. I'm very cautious about those data sets, and that has to do with the fact that there are endogenous choices embedded in that data. A single institution can and often does, especially if it's sizable, generate bespoke trading practices that are very specific to it and its order flow, and that means that generalizing from that data are quite difficult. So what are we going to do in this paper? We're going to try to do two big things. The first is to basically describe anatomy. So for those of you who remember, roughly 25 years ago, there was a very, very nice paper published in the JSC by Don Kyman and Anth Madhavan called, I think it was called The Anatomy of Institutional Trading or something like that. And it basically laid the foundation of that literature and said, here's how trading works. The first part of this paper is very similar to that in the sense that what we are trying to do is lay out the anatomy of trading algorithms, buy-side trading algorithms. It's important because certainly if you think there are problems with the market, then anatomy informs diagnosis. And if you're going to suggest cures, then you can't do cures without diagnosis. That part of the paper I'm going to break up roughly into three parts. One is going to be gross anatomy, which is going to be parent level orders. And if you remember your anatomy class, if you took one, then gross anatomy, after gross anatomy, sometimes there's work on cytology, which is the study of individual cells. In our case, that will correspond to child orders. And then there's tissue level analysis, which is referred to as histology. And in our case, that will correspond to runs of child orders. After anatomy, I'm gonna focus on the trade-off between the likelihood of execution and transactions costs. Again, I don't think I need to tell this audience, but that's a fairly fundamental issue. And it's certainly a building block for order choice models and price formation. So very quickly, let me walk you through what the trading process looks like for the prototypical organization. You have an asset management firm. That asset management firm, I hope you can see my cursor, might run, say in this example, 3 funds. Those funds generate trades in the morning, or orders, I should say, in the morning. They go to the OMS, an order management system. Those orders get blocked, as in put together. Sometimes if there are crosses between them, then those crosses go through a 17A- system so that only the residual is traded. That blocked order then goes through compliance and staging and eventually to an execution management system, the EMS. The EMS typically takes that blocked order and then sends it out to brokers. The red is where our data are going to be focused. The blocked order that's sent to a broker is typically sent to one broker, not 2. So if you're trading Microsoft, you're going to send it here, not here. And the reason for that is because you don't want to be competing against yourself in the marketplace. That broker is then going to submit that order flow to markets via one or more algos. And this red is sort of the data that we will work with and see. So our data come from a large provider of algorithmic trading services. This is a global firm, a very well-known firm. It's a very diverse client range, everything from sort of standard buy-side, long-only managers to multi-asset hedge funds. The clients that use the algos that we are going to describe and analyze. There are 961 of them, so plenty of them. The time series is long, 2012 to 16. And we are specifically going to focus on 4 standardized, non-bespoke, and very much single stock algorithms. So we're not looking at baskets or program trades across securities. Very standardized algorithms. These are the algorithms that are often white labeled and sold to other brokerage firms. If you went to any random brokerage firm, they would have the equivalent of this sort of algorithm. They use direct feeds. Everything is in milliseconds with fixed tags, so we know exactly what data element we're going. It's standardized communication protocol throughout industry. The parent orders that we're going to study represent about $675 billion in demand. They trade virtually everything, about 5,000 securities. So again, this speaks to generalizability. What are we going to see? We're going to see a parent order, how that parent order translates into all child orders, those filled and those not filled as well. So we'll see every single submission. And then finally, we will see fills for each of them. So out of the 2.3 million parent orders that get generated for these algorithms, they'll generate about 300 million child submissions, which represent about $2 trillion in notional volume. You'll notice that the notional volume of the child orders, 2.1 trillion, is much, much bigger than the parent order demand, obviously, because child orders, not all child orders will get executed. And then the final traded volume is about $388 billion. So what do we see in these data? At the parent level, we see a client ID that is not reused, so we can track a client over time. Not that we care to, but it is available to us. We see the type of algo that's used to protect the confidentiality of the firm itself. We're going to disguise the algo type. We'll call it A, B, C, and D. We'll see IDs that link to each child. We'll see a stock symbol, etc. And we'll see buys, sells, and short sales. So that SS moniker that you'll see me use thereafter is short sales. Starts and end times, order quantities, prices, volume constraints that I'll talk about in a minute. As I said, every parent order translates to a child order. So we'll have an ID linking to each parent. We'll have send and receipt times, order types for market limit and peg orders, including limit prices, display instructions, execution instructions, which is fixed tag 18, time enforced, for example, whether it's an IOC order or not. Every single venue, detailed venue information, prices and quantities of the fills, and this is the last liquidity indicator that is used in industry to determine whether the child adds, takes, or reroutes liquidity, and of course the fee and the rebate information. So pretty comprehensive coverage of every aspect of a child order. Let me pause, I think, at this point and hand it over to Bjorn.
Thank you very much. That's a data set I think everyone would like to have. Very timely, we have one question here from Andrei Shkilko. How representative are these data in terms of percentage of institutions and type of institution? Are these institutions generally informed or uninformed?
So it's very hard for me to answer that question because I do not know the identity of those institutions. I do, however, know that the coverage of institutions for this forum is extremely broad. Now, whether an institution is informed or not depends on how one thinks about information. I can tell you, for example, there are hedge funds in here, but if anybody's ever looked at hedge fund performance, whether they're informed or not depends on whether you think they generate any alpha or not. So I can't directly answer that question, but I will tell you that coverage is extremely broad across the gamut, everything from standard mutual fund holding companies, investment management firms to little old hedge funds. I'll provide a little more detail in a few minutes.
Great. So maybe I'll just add a question there. So is this particular algorithm provider known for being highly sophisticated relative to its peers, or is there anything that you can say about this? What segment of the market you're capturing here?
Yeah. So the algorithm provider is one that is regularly ranked in the top 10 brokerage firms, both by volume and in terms of reports that industry generate in terms of the capabilities of algorithm providers. So it is relatively sophisticated. Whether it is the best or not, I think is, we know what rankings look like. There are, 30 schools in the top 20. So, it is what it is.
Great, thanks. So let's proceed with the next segment here.
Okay, so let me start talking about parent orders. This I think will help answer some of those questions. This is the dollar distribution of volume from these algos across institutions. Remember, I told you there are 961 of them. And so the important thing to note here is there's lots of little pieces of this pie here. The biggest one, this green one, constitutes about 8% of the total volume, parent order volume here. So it's pretty well distributed across institutions. So I'm not terribly concerned about if one institution, say a Vanguard or something like that, dominating the order flow and therefore dominating the conclusions of what we see. Before I go on, I should mention I'm going to try, because there's a lot of data here, obviously, I'm going to try to do everything in graphical form as much as possible to make absorbing this material relatively easy. This shows the distribution of parent orders both by number and dollar volume across the algos. So you can see algos A, B, C, and D down here, and buy sales and short sales. Both in terms of the number of parent orders and the dollar volume of parent orders, you'll see that algo D, which, if you know this area, you can probably guess which one it is, but I won't say, dominates by far. It's a very, very popular algorithm. So lots and lots of orders, parent orders, both in terms of number and dollar volume coming from algo C. You'll also notice that buys are typically much higher than sells. Depends if you want to lump in short sales here or not. If you lump in short sales with sells, then roughly the distributions of buys and sells are symmetric. The size of the parent order, I've got two metrics here. One is simply in dollar terms. So you'll notice that algo C has pretty large order sizes. These are average order sizes, so there's some skew here, obviously. You know, the average for buys from algo C are what, about close to $700,000. And then there's interval volume here, which is, or the size of the parent order scaled by interval and volume, which is the volume of the duration that the parent order is live. Again, you'll see numbers that are fairly high. Notice especially for algo A, they're pretty high. So these orders are trying to, or attempting to trade you know, a fair amount of the day's volume, so you'd expect them to move prices. The duration, how long do these parent orders sit around for? Again, there's variation across the algos. You'll see anywhere from, you know, 20 minutes here, this is the average, to about 100 minutes here. So they are persistent in the market. They are trying to trade. The medians are obviously smaller because there's a lot of skew here, but the inter-algo variation that you see is very much there, and it's systematic. So not all algos are built the same way for obvious reasons. But you know, even at the median, you'll see some of these, they sit around. This one is relatively short. You know, the most popular one here sits around for 20 minutes trying to trade. So this is not insubstantial. Let me talk briefly about constraints and cancellations. And before you look at the picture up here, let's look at the picture down here. So this is the way constraints work in these algos. So let's suppose the parent starts here, and it might have a price or volume constraint, and the price constraint might be like a parent limit price that says, you know, don't buy above $50 a share. And when the prices cross $50 a share, that constraint kicks in. For a volume constraint, it might be something like, don't be more than, you know, 3% of volume over the last five minutes, or whatever it is. So the constraint kicks in. The constraint can subsequently end, and of course it can start back up and end again. So we measure each of these intervals using detailed data by linking it back up to market information. And at the parent level, we know where there are constraints and where there aren't. So as I said, you can have volume constraints, price and volume constraints. And of course, the parent order can be canceled prematurely as well. So what you'll see here is the presence of constraints are relatively similar across buy sells and short sales, but the variation across algos is fairly substantial in terms of the constraints. So algo A, for example, tends to use price constraints a lot, whereas algo B does not. That's going to get reflected in the cytology as well, or the child orders themselves. And you know, I don't think I need to say this, but everything is endogenous to the purposes of the algo itself. Bjorn, would you like me to hang on here for questions, or shall we continue?
Yes, I think we can make a brief stop for questions, because we have 4 questions that have come in. And one is from Cameron Pfiffer. How many of these orders go to multiple algorithms? And if they do go to multiple algorithms, what determines how the parent order is allocated?
So a parent order is one that is applicable only for a particular algorithm. Now, the manager or trader who is sitting above the desk or at the desk can, of course, send, say, 100,000 order to a share order to algo A, cancel it, and then submit a different one in a different algo to algo B. Perhaps we could retrace that. I don't think it happens very often. Generally speaking, when you hand off a parent order to an algo, you're sticking to the algo. It has a particular set of trade-offs built in.
Okay, thank you. We have a question from Angelo Ronaldo. Is the distribution the same across the day or the time, or are some algos more active in some points of time?
Intraday distribution, that's a good question. Honestly, I don't know. I don't think we've looked, but I'm taking notes, and that's something that we will take a look at. Thank you.
All right. So I'll take one more question before we continue. From Daryl Duffy. Are volume constraints relative to total volume across exchanges, or are they applied exchange by exchange?
They're typically applied across exchanges. So it's total market volume that comes through. So for example, a constraint that says don't submit orders, don't cross the 5% of volume exchange is done across them. Sometimes, so it depends on the algo itself. Typically, these are exchange feeds plus CTS that's used to compute this, just in case dark volume is not getting adequately represented.
Great, thank you. So let's continue with the cytology. Okay,
so child orders. Let me start showing you sort of distributions of child orders. This is a distribution of child orders, both the number of child orders and the number of fills. And the first thing you'll see, and the graphs below show the dollar values, but it's quite similar. So each parent, so these are averages across parents. Each parent contains, let's say, between 100 and 150 child orders that it generates. The number of fills is roughly 1/10 or maybe a little bit above that. So you can see sort of a submission to fill ratio here that's fairly consistent across the algos. That's just the nature of the trading mechanism at work here. If you start to look by order type, you'll notice here, for example, there are 3 colors here, although you can barely see one color: market, limit, and peg orders. These are exchange pegs here, not synthetic pegs. So the repricing of the peg order is done at the exchange. The first thing you'll notice here is that for each algo, the percentage that are market orders is absolutely tiny. It's barely visible here on C and a little bit on A, but you really don't see anything else. You'll notice that this is quite different from those of you who are familiar with the retail data, Paul Tetlock's work, or Bomer, Jones, and Zhang. The use of market orders by retail investors is, I think, in the region of about 50%, if my memory is right. And you can see they're almost never used here. Most of it is limit, and some of it is peg. Of course, those limit orders can be marketable or not, and a good fraction of them are marketable. As you can see here, there's variation, but certainly there's plenty of non-marketable, marketable limit and peg orders that are also getting submitted, unsurprisingly. I told you that we see everything in terms of venue, so we see every single exchange and dark pool represented here. I don't think it's a useful way to describe the data to show every single dark pool and exchange. Instead, we aggregate this up in 2 ways. We show, first of all, lit versus dark venues. That's the red bar. And whether the order is displayed or not. Remember that orders can be non-displayed on exchanges as well. Those, I think, are the most useful ways to describe the functionality of these orders. And what you'll notice again is that the use of display or lit venues vary significantly across algos. It's very similar across buy sales and short sales. That I don't find terribly surprising, but the variation across algos is quite systematic. Again, all of this is going to speak to price, time, and quantity trade-offs, which I'll get to in a few minutes. This is just sort of motivational, if you wish. So let me start talking about choices and outcomes at the cell level, at the cytology level. So I'm going to break up this section into 2 parts. One is choices, so the choices that are being made in these child orders, and then I'm going to talk about execution risk, or the outcomes, execution risk versus transactions costs. And I'm going to do this using fill rates, time to fills, and costs here. So let's start with choices. So we take every child order and place it in one of 5 buckets. You'll notice this bucket here, this is marketable child orders. There's midpoint priced child orders and passive child orders. Of course, for when the spread is wider than a tick, then you can also place orders between the midpoint and the passive side of the spread, or between the midpoint and marketable side of the spread. So I've got 5 buckets here. Peg orders, obviously, because they can only be pegged to the midpoint, or the passive or marketable side are only in 3 buckets. The second thing you'll notice here is that I'm making a distinction here between all orders, unfilled orders, and filled orders. Of course, I know ex post what's filled versus unfilled. And the most interesting part of this that you'll see is, so the y-axis here is the median scaled order size. So this is the size of the order relative to the displayed size of the NBBO. So how big is the order relative to how much size is displayed at the NBBO? You'll notice that passive orders are tiny relative to what is existing at the NBBO at the time, whereas marketable orders are bigger. Of course, that, again, this is a trade-off here. It's an adverse selection trade-off with respect to passive orders. You don't want to post too much. You don't want to be too big a part of the book. And that's why you're seeing this, very small set of bars here and much bigger here. I would ignore the 2 bars on this side and this side, because obviously there's a selection bias, because the tick has to be bigger than a penny for orders to even show up there. Similar pattern for non-displayed orders. You can see a similar pattern for peg orders. And for displayed, the numbers are a bit bigger, but again, a similar pattern here, right? So this is simply a quantity price trade-off that's taking place here. So let me show you fill rates. This I find actually one of the most interesting pictures that came out of this. This is fill rates for, let's start with all limit orders here. So this represents the number of orders that are marketable in millions. And the percentage of those, the difference in the 2 colors shows the percentage of orders that are filled versus non-filled. And often people ask, well, how can you have a marketable limit that doesn't fill? Why is the fill rate not 100%? There can be lots and lots of reasons for that. Of course, it could be a dark order. So marketable limit that's dark is not guaranteed to fill. It could have minimum fill instructions associated with it. So minimum fill instructions, even if there's a contraside order, are not guaranteed to fill. Even if it's a displayed order at a lit venue, it's possible that it doesn't get executed, even because there may not be a contraside order at that price, and the order may not be routable. Depending on the exchange, NYSE will reject it, NASDAQ will reprice it. The bottom line is that you may not get a fill. So the important sort of economic context here is that marketable limits still have execution risk in them. That's kind of important, especially for order choice models that often, think, function only off of price, and you think, okay, it's a marketable limit, it should get executed and there should be no execution risk. That's not true. The matching engine protocols really do make a difference in terms of what fill rates look like here. The other 4 graphs here sort of show similar patterns. Obviously, the fill rates for displayed limit orders are higher than for non-displayed limit orders, but again, you would expect that given the matching engine protocols across exchanges and venues. Let me start talking a little bit about time to fill. I'm not going to show a lot of pictures here. There's a detailed table in the paper that walks through this, but generally speaking, for orders that are ex post filled, the time to fill is obviously much bigger. Time to fill for passive orders is much bigger than time to fill for marketable orders. So there's a time trade-off in here. For if you submit a marketable order, but it's ex post unfilled, then the cancellation time is very, very similar to the time to fill. In other words, you sent a marketable order. If it doesn't fill, you cancel it relatively quickly, et cetera, et cetera. There's more information buried in the tables, but I won't, in the interest of time, won't delve into it. The general point I do want to make is that cancellations here affect the conditional distribution of the time to fill. In other words, that there's censoring going on. And that censoring is sort of important. And execution risk here is a function of not just the choice variables that the child order represents, but also random market conditions. So to model this in a sort of cohesive framework, we estimate these accelerated failure time models that were first done by Lowe, McKinley, and Zhang back in 2002. And these are sort of parametric survival models. They use the gamma function. They're basically modeling the life of the order, but recognizing the fact that there's some censoring going on here. So I said I would try to do everything with pictures, and I will, even though there are numbers up here. I'm going to focus on two little things here. So these are estimates from those accelerated failure time models. The two things that I'm going to focus on is the difference in time to fill from whether an order is marketable to passive. So a change in price aggressiveness, if one submits an order from marketable to passive, increases the uncensored time to fill from roughly a millisecond. If it's a marketable order, it's either going to get filled or canceled relatively quickly, to about 450 seconds. So it's pretty substantial. There's your price-time trade-off as opposed to the price-volume trade-off that I showed earlier. The second thing that I'm going to highlight is this the interpretation of this display dummy variable in here. Displaying an order, roughly speaking, halves the time to fill. So again, here the primitive trade-off here is cost, right, versus time, because display may affect the cost functions that are embedded in this. And finally, I'm checking the time. Looks like I have about 7 minutes. Let me talk a little bit about price movements. So again, going back to canonical theory, the old theory models constructed in the 80s and thereafter, it's trades that typically incorporate price information, prices. And passive quotes are provided by market makers who really have no intrinsic motivation to trade, and they just basically supply liquidity and don't contain any private information. You can have zero profit conditions or monopolies in there, but regardless, that's what's going on in those models. And so the question that we're going to ask here is whether the expression of trading interest, i.e. those limit orders, move prices, and those child orders, whether they move prices. I do want to mention that there is a very nice Journal of Finance paper by Burgard, Hendershot, and Reardon in 2019 that I'll talk about in a second, that also looks at price movement subsequent to the submission of limit orders. Before I go on, let me remind you of one thing, which is that, remember, we see every child order and we see whether that child order is filled or unfilled. If a child order is filled, remember, it's more likely to be marketable if it's filled. The median time to trade is pretty fast, 5 to 10 milliseconds. So when we measure price movements, we have to be awfully careful about measuring price movements. So we're going to measure quote midpoint changes from the time of submission of the child order or the time of execution for a fill. Ex post, we know whether something is filled or not. Over a variety of horizons, 100 milliseconds, 500 milliseconds, et cetera, so on and so forth. We are deliberately going to separate out these estimates for filled versus unfilled orders, because for an order that is filled, particularly if it's marketable, the time to submission, time to fill is so fast that any measurement of both of those is going to get conflated. There's going to be an overlap in them. So let me start to put this in context. Let's take unfilled child orders here. These are unfilled child orders with a submission price that, run the extremes that are aggressive, i.e. marketable, versus passive. And these price impact numbers that run out to about 10 seconds or so. I'm going to focus on the 10-second numbers simply because of comparability here with other papers in the literature, and in particular the Burgard-Henderson-Reardon paper I talked about. So that paper looks at 15 stocks on the Toronto Stock Exchange, if my memory is correct, over a 9-month period, and their estimate was about, I think, 0.69 basis points. Sort of in the same sort of ballpark out 10 seconds. That's why I'm focusing here on 10 seconds, but we can obviously look at shorter horizons as well. The big difference you'll notice here is that orders posted on the far side of the spread, i.e. those who are marketable, move prices by about 2 basis points. And if they're passive, they move prices 0.84 basis points. So that's close to the 0.69 with a much broader sample. The important part here is, I'm not showing you standard errors, but trust me, they're tiny, even when you aggregate up and use daily data. The important point here is that this is non-zero. Orders that we know that are ex post unfilled are still moving prices by substantive amounts. Same is true for PEG orders. If you look at the filled orders, they're moving prices. Remember, for filled orders, we're looking at it from the time of the fill. They're moving prices, and if they're passive, why are these numbers negative? Remember that these are passive orders, so prices have to move into you. And that's why those numbers are negative. Let me show you a triple sort, sort of a complicated triple sort, but it helps to get at both quantity, prices, and display. So 3 things jointly together. So first of all, there are 2 bars here. There's the blue and the green. The blue is unfilled orders. The green is filled orders. The quartiles, Q1 through Q4, represent quartiles of child order size as a percentage of the NBBO. So these are small orders. These are big orders, big child orders. And the y-axis contains price impact. So the first thing that you'll notice here, this is just for marketable limit orders. So you'll notice an upward slope here. That shouldn't surprise you, as the bigger an order gets, the larger the price impact. The other thing that you'll notice is that non-displayed orders, oops, looks like my, non-displayed, or I beg your pardon, displayed orders have, generally speaking, larger price impacts than non-displayed orders. Again, that shouldn't surprise you. You can look at the same thing for passive limit orders, marketable pegs, and passive pegs. Basically, you'll see the same pattern here, that there is a quantity trade-off here, that there is a display trade-off here with respect to price. Now, I can stick everything in a regression, and I'm going to skip, again, in the interest of time, I'm going to skip regressions and take 2 minutes very quickly. I promised Bjorn to talk about strategic runs. So what's a run? So this is the tissue level analysis that I described. A sequence of child orders is obviously not random. A very nice paper by Hasbrook and Sauer some time back that looked at not institutional data, but market level data that sort of investigated this. But the child orders are not random, obviously. They have a common goal. They're trying to execute while minimizing costs, something like that. And they have a shared code base. So we're going to define a run as a sequence of child orders that comes from the same parent in the same price aggressiveness category. So you're a parent, you have 200 child orders you're going to submit, and let's suppose you stay passive, 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 and then you go intra-spread, 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 et cetera, et cetera. I'm going to collapse the categories into, instead of 5 price categories, I'm going to use 3 of them, marketable, inside, and passive, and focus my attention on parents that seek to trade at least 1 basis point of ADV with at least 50 child orders. That keeps the analysis sensible. So the first thing that you'll see is that there are a lot of runs per parent, about 63 runs per parent. about 8 children per run, and the runs last a while, about 566 seconds on average. They have a fair amount of volume associated with them. And the percentage of runs that are passive versus inside the spread versus marketable, you can see the variation down here. These are transition matrices from one run to another. This is T-1, this is T. And you'll notice that they are pretty similar across the algos, actually. So the variation, whether you go from, say, intra-spread in algo B at T-1 to passive at T, that transition matrix, that probability is about 13% or so. So there's a fair amount of stability here, and that's simply because the algos are trying to execute. So again, very quickly, we're going to estimate some simple logistic regressions here, where these are sort of conditional logits, if you will, where we're looking at the probability that the run is marketable, given that the prior run was passive, for example. And the 2 key variables of interest here are whether the prior run contained a fill, so this is a quantity trade-off here, and what the signed return looked like over the duration of the prior run. Again, without going into too much detail here, what I'm going to focus on is the numbers themselves. These are probability changes. The big thing that seems to be going on here is that whether a run is marketable or passive really depends quite significantly on whether the prior run received a fill or not. So quantity trade-offs here seem to be quite important. So I am, I think, 2 minutes over time. Let me just say that this is tricky to get done in time, but the important parts that I think are worth remembering is that these algos have a lot of trade-offs built into them. The trade-offs are really quite primitive. They involve price, quantity, and time. Those are, and display is a feature that, whether you want to build into those 3, whether you think it's primitive or not, we can have discussions about, but that's what's represented here. Let me stop at this point.
Thank you very much, Sunil. Really interesting. And we have many good questions lined up. And now I've activated the raise hand function in Zoom. So if you want to ask a question, feel free to raise your hand. And I'm going to start by giving the word to Amy Kwon, who has a question. So Amy, you can activate your mic now, I think, and ask your question.
It's not actually Amy, it's her husband. It's midnight in Australia and it's Richard Phillip. But so if I don't sound like Amy, apologies. So just the question was, there was unfilled limit orders had a positive price impact in the tables, and I guess the question was, is this because the unfilled limit orders have information? Or is this just because the price has moved away from these unfilled limit orders because other informed market orders are coming in at the same time that pushes the price away from the limit order and it doesn't get a fill and it just appears that there was a price impact from it?
I think it is the former, not the latter. We don't, I didn't talk about it during the presentation, but we ran some little placebo tests that randomly picked timestamps and looked at whether prices were moving sort of in that placebo test, and you don't see it in the placebo at all. So it is the idea that when you post something to the book, particularly if it's visible, but sometimes even when it's not visible, non-visible things can quote unquote get displayed when an execution hits. And people draw inferences about whether it's a non-displayed order, but especially when it's displayed, that contains information. Now, I won't speculate about what kind of information it contains, but it does move prices.
Okay, we have a related question from Thierry Foucault.
You hear me?
Yes.
Yeah, no, my question was about the negative price impact for the field limit orders. I was surprised by this result. There is a forthcoming paper in the Journal of Finance by Jonathan Bogart, Terry Undershot, and Ian Riordan, in which they show that limit orders contain information. And so execution of a buy limit, for instance, will move price up. And you seem to find the opposite result for your in your data. So maybe because this is of course you are looking at specific clients, so that might be the reason, in fact.
Yeah, I think what's going on here is the difference between when you look at price movements post-submission versus post-fill. So if it is a filled order, so ex post we know it's filled, and when we measure price movements subsequent to a fill for a child order that is passive, you know, the way a passive child order gets filled is that prices, you know, consider a buy, then prices are moving into it. So they're dropping in this example, and they continue to drop thereafter. So that's what's happening on the buy side. Midpoint is a little bit more complicated because it depends on whether the midpoint order is a resting midpoint order or whether it's taking liquidity. So it depends on whether it's resting or extracting, and you can have a variety of midpoints. Even our data are not comprehensive enough to tell us the variation in midpoints. But you know, I can tell you from other data that I've looked at, it makes a difference whether the midpoint is a resting midpoint or it's taking at the mid. So I don't think there's a discrepancy here. I'll take a look at that paper, but I don't think there's a discrepancy here. It has to do with timing, whether it's a submission or time of fill. There is, I'll add one other thing, for a small subsample where an order is filled, but there is a sufficient amount of time between the time of submission and the fill. And for those orders, we can measure post-submission price movements as well as post-fill price movements. We can really only do that at the 100 millisecond level, maybe at the 500, but not much more than that because of the timing difference. And for those, we see exactly the same pattern.
Thank you. So we have a question from Hao-Chang Xu. And after Hao-Chang, I'll give the word to Daryl Duffy.
Hello, hi, Sunil, really interesting talk. I wonder if it's possible to separately analyze the quote-unquote informed versus uninformed investors. In your data, it seems possible to guess how informed they are based on the subsequent price movement. And all these, you know, we have a lot of questions about what's the fundamental execution strategies of informed investor versus uninformed. And I guess this result, if possible, would also shed some light on what are the better ways to improve on their execution.
I don't know if you can see me, but I'm smiling.
I can see you, absolutely, yeah.
You are one of N, where N is a decent sized number of people who have asked that question. And honestly, the answer is that we have to be very careful with the data provider. We have a very carefully constructed agreement that says that, you know, we're not going to go in and ask, you know, things of that nature. We may be able to do it, but I do have to tread very carefully to be able to do that. We could potentially ask it, but you know, let's suppose there are 961 quote unquote institutions in here. So let's suppose you found that 500 were informed by some ex post metric and 400 were uninformed. I think that's useful information. It tells you about the nature of trading out there. And we could certainly go in and look at the 500 in detail, but we have to be careful with it. So maybe it's something down the road.
Got it, thank you.
Okay, Daryl Duffy.
Sunil, that was fascinating. I have a question about how large buy-side firms split their orders not only across time, but across exchanges. Conversations suggest that they do both, and I'm wondering whether you can use your data or you have used your data to inform us about how they do that and whether the way that they do that depends on the scale of the total order interest.
The answer is we can certainly do that, but I can also tell you from work that I've done over the past 10 years or so that the way that the orders are split across the 40-odd venues in the United States is a function of the more primitive trade-offs that that are embedded in the different venues. And by those trade-offs, what I mean are price, quantity, and time. So for example, an algo such as, dare I say, algo A, that is more interested in getting things done, as in executed, routes orders, or the order routing system within those algos are more likely to route based on a routing table that gives weight to realized volume over the past day or 5 days or something like that. Other algos, like say algo D, are more concerned with the quality of the execution, as in the ex-post price movement subsequent to fills. And in those, the weighting system that's in a routing table is weighted more towards execution quality as opposed to execution risk. So the routing tables essentially take a venue as almost sort of an exogenous parameter and then program it in and say, okay, here's how we're going to do the routing. The other thing I'll say is that these routing tables are dynamic. They're not static, so that they are updated in two ways, either by the algo, but also by the institution. So the institution can go in and say, hey, I don't like IEX, or I really want you to route my orders to IEX. Something that retail investors have no control over, but institutions can go in and change those routing parameters. That can be done within an algo. It's a customizable parameter often, but not always. So it depends on the algo itself.
Thanks so much, Sunil. Very helpful.
Okay, I think we have time for one final question, if anyone wants to raise their hand. So we have Andrei Shkilko.
Hi, Sunil. Thank you very much for this very interesting paper. I waited till the end because this is a question about the part of the paper that you didn't get to, and that has to do with order anticipation. I think the paper says that you find no evidence for that. And as I was flipping through the tables, something that jumped out at me was that the median order size, the median parent order size, I think, looked relatively small. Do you think that that is one of the reasons order anticipation doesn't show up? Thank you.
So let me say a couple of things with respect to order anticipation. When we do the work on at the child level, the cytology stuff, we are deliberately treating every child order as independent. So we're doing that under the maintained assumption that the child orders, that there's no order anticipation going on. There may be, there may not be. We can't provide evidence one way or the other because it's really, it's tough to make that case. I can understand looking at pre-submission and post-submission, pre-fill and post-fill price movements to infer something like that, but we really don't see strong evidence for that. So your question was, is that because the median order size is small? We have, a huge range of order sizes in here. So we could certainly look at the larger orders, and the larger orders are still pretty big. Remember, there was a big skew in order size in terms of means, medians, and to the 75th percentile. We could certainly look at those and see if there's anything going on there. Personally, I'm really quite skeptical of it because there are so many places to hide And there are so many free parameters here for an algo that I think order anticipation is a tough game to play. It's also a game that involves considerable risk, counterparty risk on the other side. So I guess I'm skeptical of it, but we could certainly dig into the larger parent orders to see if it's going on there.
Thank you so much, Sunil. We're out of time. So thanks a lot for coming to the Microstructure Exchange. I'm sure everyone is now clapping, even though we can't hear it. Next Tuesday, we have Angelo Ranaldo from St. Gallen. He's going to talk about asymmetric information risk in the foreign exchange markets. So I look forward to see you again then. And for those who weren't here in the first few minutes, check out our website. We have a couple of announcements there with a database and a call for papers if you scroll down. And this session is now over, and I will stop the recording. But Sunil will stay in the room for 10 minutes or so if there are anyone is interested in a post-seminar chat. So thank you, everyone, and bye for now.